There is no move, but there is a warning. The target range stays in the range of 4.25% to 4.5%. But Fed officials warn, quote, uncertainty about the economic outlook has increased further. And they go on to say they, quote, judge that the risks of higher unemployment and higher inflation have risen. The economic assessment has changed after last week's report. The economy contracted in the first quarter. Although swings in net exports have affected the data, the minutes say, recent indicators suggest that economic activity has continued to expand at a solid pace. No change to their view. The labor market remains solid. Unemployment has stabilized at a low level in recent months, and inflation remains somewhat elevated. No other changes to the statement. Again, the committee will assess incoming data, the outlook, and balance of risks in considering the extent and timing of additional adjustments to the target range. There's no change in balance sheet policy, which was adjusted in March, and the decision was unanimous, with Minneapolis's Neil Kashkari voting as an alternate for Kansas City's Jeff Schmidt.
And our thoughts are with him, that's for sure, given the circumstances that led to that. Mike, thank you, sir. Mike Sonnet, second paragraph at the very bottom of it. The committee is attentive to the risk to both sides of the dual mandate and judges that the risks of higher unemployment and higher inflation have risen. And that is the central banker's dilemma.
The stagflationary environment that every central banker wants to avoid. The initial knee-jerk response in markets is interesting in that its yields lower. There is a question whether that can continue all across the curve, as there's a question around just the new structure of trade and the uncertainty that is weighing on businesses.